Good afternoon and welcome to BizTech Asian Midday Market Watch on Friday, the 12th of April. I'm Samantha Voon, and today we're joined by Kelvin Wong, Senior Market Analyst of Oanda in Singapore. Kelvin, good afternoon.
Hi, good afternoon to you and happy Friday, Samantha.
Happy Friday. Okay, so before we get your insights, let's take a look on how the markets are performing in the regional stock markets. Okay, wow, everything's looking like it's going down, except for the Japan Nikkei 225, up 0.32%, and the Shanghai Composite down 0.01%. In Hong Kong, the Hang Seng is down 1.64%. In Australia, it's down 0.38%, and the South Korean Kospi down 0.9%. And in Singapore, the STI is down 0.29%. In Kuala Lumpur, is down 0.19%. Kelvin, what do you make out of today's performance?
Yes, so if you look at from the major Asia benchmark performance as of now intraday, it seems to be moving in a desynchronization mode against the major benchmark US indices, where yesterday the major US benchmark indices managed to actually close rather positive, led by technology stocks, which is all around driven by macro factors like the positive AI news flow up from Apple. So much concern about the Asia stock market perspective is due to this risk of this rising odds, I would say, of currency war. So maybe let me talk about this currency war perspective. So as we know that since late last week, and it's being kind of reinforced by this week hotter than CPI, I was not hotter, maybe firmer than expected US CPI data for March. So that has kind of reduced or diminished the what you call it, the highly anticipated Fed dovish pivot narrative that was initially kind of being priced in at the start of this year. So with the US Federal Reserve officials getting less hesitant to enact its first interest rate cut, and right now, given this firmer US CPI data on the backdrop of much more, what you call it, uptrending commodity prices, especially from oil, that has kind of increased the risk of a supply side inflation creeping back into US. So that being said, there's now a risk that the US Federal Reserve may only enact one interest rate cut, and with the possibility of even no interest rate cut that is being kind of remarked by one of the US Federal Reserve officials. So all in all, right, that has led to the spike up in the longer term US Treasury yield. So especially market participant has been watching that 4.5% key resistance level, I would say key medium term resistance level on the 10-year US Treasury yield that has been breached slightly yesterday. It went above it. So that actually increases the risk of what I call that a much more pronounced dollar strength coming back into the FX market in the medium term perspective. Especially yesterday, we do see a much more, I would say that a kind of a reiteration of that dovish guidance from ECB, where ECB President Lagarde had mentioned that they are actually looking at the lens of monetary policy from an intermittent perspective. And she actually gave more or less a kind of a high odds of a guidance of the first interest rate cut in Eurozone to come in June, much earlier than what is markets pricing in for the US, which is now being pushed down further to September. So that overall lead to what I call it dollar strength as really seen on the Asia currency. So the anchor of the Asia currency for sure will be the dollar yen. The dollar yen now is actually trying to actually prop above the 7.3 level. And bear in mind that, do not forget, the China top policymaker has already given their mandate for China to actually meet that rosy high level 5% GDP growth on the backdrop of deflationary risk that is still prevalent in China. So the only way for China to actually meet this high level expectation of 5% GDP growth is the only way to actually put it away that to pump up or juice up export growth, potentially via a weaker yuan. So that actually kind of kickstart that potential currency war back into the forefront again. That does not gel well for the major stock indices at this point in time. So that actually explain today's we call it lackluster performance on the major major benchmark Asia stock indices going against the positive flow seen yesterday in the US benchmark indices.
All right. Okay. I mean, since we're on that, well, in Singapore, the Singapore economy looks like it's on a positive track, with the MTI
Yes,
announcing positive GDP growth data for quarter one, right? And also a
yes.
revised upwards GDP growth forecast. Walk us through this, Kelvin, and also what are the potential implications on the Singapore dollar?
Yes, for sure. So, yes, we do see from a year-on-year basis is rather rosy. So, a year-on-year basis, the flash GDP quarter data grew of 2%, 2.7% year-on-year from the previous quarter of year-on-year growth of 2.2%. But if we break it down from a quarterly basis, that means Q-on-Q basis, in fact, the growth was rather lackluster. So, if you look at the adjusted, seasonally adjusted quarterly growth for Q1, that's the flash data, is only marginally up by 0.1% Q on Q. So that's actually a slower pace than previous Q4 Q on Q growth of 1.2%. And this, we call it a lackluster quarterly growth of 0.1% Q on Q is being dragged down by manufacturing growth, which actually slowed down to 0.8% year on year in Q1, which that's down actually 1.4% in the previous quarter. So if you look at the situation in Singapore economy, yes, the overall numbers may seem rosy, but if we dive down deeper into the component, manufacturing growth, which is another significant, we call it sector that drive Singapore growth on top of financial services, has starts to actually taper off. So that actually could also explain to the we call it the deflationary risk scenario that is still prevalent in the Chinese economy. And bear in mind that Singapore do have a significant our Singapore growth do have a significant relationship with China economy in the last few years, given our trade ties with China that's grown significantly closer as well. So, given the fact that now there's a potential risk of a currency war on the horizon due to the back of the much more less dovish Federal Reserve that is kind of triggering this medium-term upbeat bullish tone in the US dollar. The dollar sing right now seems to be in the in a mode of upward move rather than a downward move. So if you look at the dollar sing from a technical analysis perspective, in fact today is actually up much higher and it's right now just a whisker away from the current 52-week high of 1.3760. Given now it's trading at around 1.3556 level. So with that bearing in mind over here is that given there's a risk of this potential currency war if the China yuan is being used as a weapon to actually drive their localized China export growth, there is actually a high probability that the Sing dollar may weaken against the US dollar in the months ahead.
Hmm. Okay. Okay. All right. So, we also have the quarter one earnings of the US banks like JP Morgan, Wells Fargo, and Citigroup out later. What are the key highlights to watch out for, Kelvin?
Yeah, yeah, for sure. So if you look at since the start of this week, the major US stock indices has been hammered down on on the aggregate due to I would say that adverse macro factors like the rising 10-year GDP, rising 10-year US Treasury yield that put a cap on net profit margin due to higher cost of funding. So right now, today's market participants will be focusing more on the macro factors for sure, especially JP Morgan, which has I think the is an 11 biggest weighted cap on the Dow Jones Industrial Average. So if you look at the previous earnings guidance, I mean way before today's earnings data release that is going to due before the start of the US session today, market has been anticipating a lower we call it earnings growth number. So in fact, if you look at these three banks, JP Morgan, on the consensus based on this LSEG analyst survey, market analyst is expecting a 4% drop in earnings per share for JP Morgan compared to a year ago for Q1 earnings, and as well as a much more significant decline of 35% year-on-year EPS growth and negative 11% EPS year-on-year growth for Q1 for Citigroup and Wells Fargo respectively. So given that the earnings expectation has been revised downwards significantly by market analysts, That means, i.e., any earnings surprise positive on the upside may be much easier to make this bar. But on the other hand, yeah, despite that, if even though they managed to beat earnings expectation due to a lower bar of analyst estimates, market participants will be hearing their forward guidance for Q2, especially given the fact that we know that right now the Fed dovish pivot narrative has been reduced significantly. That means we may start to see a greater chance of having a higher interest rate level staying for a longer period of time. So that could potentially increase delinquency on these three banks' consumer businesses, especially on the credit card, and also the commercial loan portfolio as well, given that the commercial loan portfolio has been a negative, we call it a headwind on the balance sheet of commercial banks. So especially these three banks, JP Morgan, Wells Fargo, and Citigroup, they do have a much more significant corporate and consumer business over their investment banking business.
Okay, thanks, Kelvin. Thanks for sharing your insight.
My pleasure.
We've been speaking to Kelvin Wong, Senior Market Analyst at Oanda, on BizTech Asian Midday Market Watch. I'm Samantha Voon, and this video and podcast will be on our website, www.biztech.asia, as well as our social media platforms. It will also be on our syndication partner TV stations, radio stations, and website. Remember to like and subscribe. Thanks for tuning in.